Good morning, everybody. My name's Kevin Uphill, and I'm the chairman of Avondale Corporate. And welcome to the Scale Up to Create Value webinar that we've got this morning. We've got about 50 minutes today, and I'll be talking to you for the first 10, 15, 20 minutes on the subject. And then I'm going to be joined by my learned colleagues, Peter and Tim, who are going to be chewing the fat with us on some of the subjects that we've discussed. The slides will be available, so we will send them out. And also, please fire away questions as we go. Don't raise your hands, but do use the Q&A panel that's on the top of your screens or on your screens. So, as I say, today's subject, Scale Up to Create Value. For those of you who don't know Avondale, we specialize in helping people buy and sell emerging mid-market businesses, but we also have a strategy service particularly focused around shareholder value and also scale up programs. Now, we like to talk about scale up. Obviously, we're very aware that with the COVID backdrop, we're all fighting into headwinds. So an awful lot of the strategy that we're going to be talking about today is equally applicable in a storm. And it's really wisdoms that we've learned over the last 30 years, helping emerging mid-market companies and seeing what works and what doesn't work. We're very fortunate we get to see about 50 of the top entrepreneurs a year in the UK and how they operate and what they do, and also how they look globally. So today, scale up to create value, but hopefully also put a bit more clarity, confidence and energy in your strategy. Obviously, again, post-COVID lockdown and with the new surge we're expecting, it's hard to stay positive and clear. And again, hopefully, we're going to bring some ideas for you in doing that. So, Tim and Peter will be joining, and you can see their pictures there to chew the fat later. But do ask questions as you go. So it falls to me to start, and I thought I'd bring the first share up of leadership versus management. Now, this concept comes from my book, Creating Competitive Advantage in Dynamic Markets. I'd like to rename it in hostile and volatile markets instead, which is what we're facing. But fundamentally, the concept is that you can scale businesses up more effectively if you're more aware as a leadership team where you spend your time. Now, this is not a new concept, and of course we raise funds for people, so we're equally aware that capital is as important as leadership. But this equation is also, if you haven't got access to capital, your outlook and where you spend your time can be just as critical. The whole leadership versus management concept comes off the back of the E-Myth concept from Michael Gerber's book, the E-Myth, which is, if those of you who know, it's where the work on your business, not in it idea comes from. And if you've all got business coaches or you've met business coaches and business leaders, you'll be very familiar with that concept. And so Michael Gerber's idea was that businesses are held back because entrepreneurs can do the job. In fact, the curse of the entrepreneur is that we can do the job, which forces them to be more hands-on rather than designing better businesses. And within that concept, his idea of designing better businesses was around processes, systems, and the idea was build your business around a franchise. Now, we've taken a look at that model and then updated it. I think the issue with it is it's great, and in some respects, from a value point of view, it's brilliant because, of course, the more valuable companies are the ones which are less dependent on the owners. So the more of a system and a process they are, then the higher the value. I think where the book probably falls down is that it doesn't take account of the fact that markets now move more rapidly. So almost whatever system or process you have that you engage in and or product set, before you've managed to get traction on the ground, that sector or market has changed. So that's one of the challenges. But actually, probably the bigger challenge we see with it is that, particularly with entrepreneurs, they like hard work, they like grafting, they started businesses because they're hard work and they're grafters. And designing a system and process and doing yourself out of a job makes people, and some people, feel very, very uncomfortable. They don't feel busy when they're in that strategy space, but they go straight back in and they get involved in the management and the firefighting. So this model really is saying, look, we've all had to spend a lot of time at the foundation level, structure, in the last 6 months with COVID backdrop, and that's fine. But ultimately, long term, we should be looking to delegate that, as we should the next tier, which is what we call the profit engine. So marketing, sales, again, ideally delegate that. And then the value for a scale-up strategy is around acquisitions, new products, strategic alliances, and territories. And how do you as a leader design the business so you can spend more time in that higher value activity? Now, obviously, with COVID, we've all been forced to look down, and increasingly also, I think the compliance headwinds in general in business is forcing the people to look down. This is about looking up. So for us, when we're working with people on a scale-up strategy, one of the really key areas that we're looking at, we call it gap analysis, but we ask the question, how much do you want the business to be worth? So we value it today. We ask, how much do you want it to be worth? And we look at that, big picture vision, and we look at then at all the different divisions and say, well, to be worth that, it needs to be a business of Y shape. And then we work the plan backwards. So it's a sort of gap analysis exercise, whereas most leaders are incrementally working the plan upwards. Now, of course, we won't hit that end vision exactly, but the power behind that drive is it pushes you into the leadership space in thinking about the design of your business if it were a bigger, more valuable business, and therefore the decisions you make on how to get there might be slightly different to when you're looking at incremental steps to grow the business. So it's really about bringing that radical thinking into the leadership team around, again, new products, strategic alliances, acquisitions, and possibly new territories, and in particular, research within achieving that. So I said earlier, I'm going to bring some clarity, confidence, and energy, and I hope we're going to do that. So, as I say, please, fire some questions and heckle if you feel I'm not. But actually, one of the key areas for strategy and bringing energy into the business strategy is questions. Too often do we see the CEO leadership team feel that they have to have all the answers. But the truth of the matter is that the best CEOs are better listeners than they are talkers, because what they're able to do is then extract all the key information and facts and process it in the correct way and put their ego aside. They are not prejudiced, if you like, or prejudgmental by their own views or decisions when they're then looking at that strategy or resetting it. So, of course, the big key questions apply if you're looking at a scale-up strategy, and these are the critical ones. Why are you really better than the competition? When you workshop that, normally, invariably, it always ends up with our people. Well, guys, everybody says that. It's not a unique selling point. Why are you really better than your competition? But also, what is your future customer going to want? So I think personally, there's massive energy in designing businesses that create pull, not push. So push is a business where you constantly got a market to create demand. You've constantly got a cost per acquisition to create demand. It's expensive to win customers. Pull is where you create a niche, you create a reputation, and people start seeking you out because you're known for being ahead of the market demand. So not only why can you be better than your competition, or how can you be better than your competition, but also what is your future customer going to want, and how can you place your business ahead of that market demand rather than chasing that market demand. And again, I think it's really critical for a scale-up strategy. Within that, of course, we can do all the research, and research is for these questions is the micro picture is, well, what's your business telling you? What's the data telling you? Which customers are most active, which aren't, which are the most profitable, which aren't? That's the micro picture, and then you can build the strategy around that. But the macro picture is, what are your competitors doing? And again, a great question for CEOs if engaging in a scale up for value strategy is, how much time have you spent looking at your competitors? Most CEOs spend a day or two a year maybe, but they don't do a really detailed in-depth analysis of what their strengths and weaknesses are. And for me, that creates an opportunity, because if we do that and we look more at the competition, we can then see the weak point and where our breakthrough point might be within any given sector or arena, so that we can then start designing exceptional companies rather than just following we can lead. Obviously, in the end, when you've got the facts, you've got the information, you've thought about your strategy, you're building the business for scale up, we need to engage that plan on the ground. And Peter Drucker's great phrase, great plans should rapidly deteriorate to action, is correct. And what we like to say is that a bad decision implemented well will outperform a good decision implemented badly. So in the end, be bold, get clear, and implement, and be decisive. And the benefit behind that is, can you imagine a world where you go into the business, and probably these days it's virtually rather than physically, and your team are absolutely energized because they're utterly clear what they should be doing, why they're doing it, and what the focus is. So actually, it's quite interesting how many people we meet still don't have a detailed plan that's been worked through. And we don't, by the way, we don't think that the business plan should be particularly long, but a 2-3 page key document that your team can focus back on really brings confidence in terms of those goals, and particularly around that gap analysis of how you create that more valuable business and where you want to get to. So energy can be built through that decision, through that research, and then through cascading it confidently. I think about focus is also important. So look, volatile world, massive headroom from COVID, but you still want to scale up, you still want to create more valuable businesses. And in the end, that is about, as I say, knowing the strategy and understanding what's important. And that takes a fresh mind. So we think that leaders still today are being forced to be too hands-on. And in the end, therefore, it's about how you figure out, your time and your time allocation. I don't know about you guys, but I've actually quite enjoyed some of the, COVID lockdown because of the lack of travel and rushing around and commuting, etc. You actually get a clearer head and you can get a clearer vision. And it's that stuff that we're talking about. And then real energy can fly from that because it gives you the power to say no. Saying no is as important as saying yes to decisions and making decisions. And one of the things that we, again, have seen a lot of when we go out and meet entrepreneurs and owners, and we're talking about why some people might plateau or not break through and create that scale-up strategy. And I think often it's because they don't know their own mind and they get a little bit distracted along the way. Most entrepreneurs have some form of attention deficit disorder. Come on, let's face it, that's why they're not employed. And what we're really saying here is, with that distraction, I call it kite flying. Often the strategy is set by who the most persuasive person is that month, whether it's within the senior team or the latest salesperson. But actually, if you get really clear what's happening in your market, the micro picture, the macro picture, you can then design your business ahead of customer demand and go for it. It gives you the power to say no with more confidence. And in the end, that's the sort of lose in order to gain principle. So which customers are more profitable and which ones do you need to say no to? It sounds a bit harsh, actually, but one of our post-COVID initiatives has been getting to know more quickly. We've realized that we are very polite and we spend a lot of time with people, even when we know that there isn't necessarily a project for us. And we're happy to chew the fat on any aspect, but in the end, we want to just get to the point of going, look, actually, we don't think really as a house it's the right project for us. So saying no is as powerful as saying yes to achieving strategy. So, of course, as I said, right at the beginning, I think, capital is important for growth. We raise funds and we're doing a lot of, private equity investment at the moment into companies, particularly around elevator deals to create scale-up strategy. But we think approach is equally as important. And within that, it's about your time and how you spend your time. And I think if you get that strategy clearer and more simply across the team and then cascade it out, then you will get a far more energy behind the vision. One of the other things I think has changed in the sort of post-COVID world, obviously virtually, I've noticed, I don't know about you guys, but I think that meetings have become more productive. Because people prepare more for them, and also they pre-send agendas out because you've got less time for the sitting down and initial rapport building, if you like. So whilst it's sad that we're not enjoying the boardroom chairs, actually I think people are getting to the point more quickly, and I think that's really, really helpful. But again, also within that context, if you set the clock, it's being clear to your team, right, this is the strategy, these are the steps we want to employ. Anything outside of that, we say no to. And that then creates power in the meetings because you can stick to the agenda. So, well, hang on a minute, it's a good point, but let's put that in the car park. We don't need to go there, and stick to the agenda. One of our good business friends is a business design org guru in America, and he works with people like Boeing, but he has a great saying, meetings are glue. We historically have meetings to hold organizations together, but actually one of the things he looks for are which are the reporting meetings, because actually if you get your dashboard right, and you get your KPIs right within a business, you can cut down on those reporting meetings. And that then gives you more space and time to have the creative meetings, that blue sky thinking meetings. So scale up for value, energy, focus, time. Obviously capital does come into it, but we're looking at what you personally can do to make a difference. And leadership rather than management. But within that equation, it surprises us how often we meet owners who are focused, well, post-COVID, it's been a bit survival, let's face it, but survival with profit, very important, but purely on profit. And actually, some of the richest people in the world have created that through shareholder value rather than profit. It's not about profit in itself. Profit, of course, is a value driver, but also multiple influences. So most companies are valued based on an EBITDA multiple, a profit multiple of earnings. And it's understanding what drivers within a business. And when you do your strategy, we're not looking at, is Fred any good at his job, or what are our COVID models? We're looking at how are we designing the business around the more valuable shareholder value drivers. And you'll see within this model, we've put quality of earnings right within the center. So for us, multiple influences. By the way, on the outside of the frame, you'll see economies of scale, synergy, market disruption, positive disruption, and shareholder value. Those are the buyer motivators. So if we're selling a company and you want to realize value, that's what we're looking for. If we can find a buyer that hits all four of those corners, you will get a higher price. But within that framework, what they are looking for are these, if you like, influencer points. And recurring revenue is by far the highest driver. So again, I'll share with you, but you've all watched them, but some of these SaaS companies, software as a service, high recurring revenue. Okay, now the biggest valuation metric in SaaS is what's the annual run rate of growth, what's the cost per acquisition of clients, and what's the retention rate. Now, look, we're not all SaaS businesses, we don't all have recurring revenue in that sense. However, designing the business so that it is more focused on recurring revenue and that feeder through is a really critical value influencer. So what can you do as a board to examine your shareholder value drivers and how you can amplify them on a pre-sale or scale up initiative? And quality earnings, of course, is the number one. There's all sorts of other elements, brand and system and processes we talked about earlier. So that, I hope, is a really useful sort of reminder on shareholder value. Now, look, I'm talking a lot at you. I do want some questions as well in a minute, but I'm going to be joined by my colleagues as well in a minute. But listen, leadership can be lonely. The definition of leader comes from the old English of letting a head lead ahead. So, by nature, that means that we are ahead of other people in the organization as leaders. And actually, that can feel very, very lonely. So we believe in collaboration, whether that's with consultants or within your own team. Now, the benefit of consultants, and yes, of course, there's a bit of a sales pitch here, is their objective, their experience, and they've seen what works in other people's businesses. Having said that, there's a whole spectrum of advisors and specialists, and it's difficult to find people who understand the emerging mid-market pain. But of course, the other collaboration you've got is your team. Now, your team, loyal team, work with you for years. Emerging mid-market businesses tend not to have as corporate a second tier as big corporates, quite understandably. They can't afford to pay the same pay rates. So what we tend to find is the gap between the leaders and the second tier is a really interesting area when you're working on a scale-up strategy, and often it's too big. So clear plans, more workshopping, more strategy, more creativity can close that gap. So not management meetings, but more of that sort of thinking, how can we better, why can we be better, and engaging the second tier in that more effectively. And again, a really great question for EME businesses. EME, by the way, is 300-400K plus profit. You've got different teething issues to the guys that are only making 200K a year, and 300-400K up to 7 million, something like that profit. Organizations 20 to 200 people, that sort of level of speciality. Now, it's interesting when you look at those organizations, how often the second tier management are homegrown and they've never been trained, okay? The other point that we've got when we're looking at them is they are mostly paid, because we like reliable businesses, to maintain the status quo. Yeah, we don't want to come into the organization every day, whether it's virtual or physical, who cares, frankly, and seeing a different chaos every day. We like to see a clear output because we've got an end in mind, which is to make more valuable companies and more profit. So those guys are paid for reliability. But actually, if you're on a scale-up initiative, what we want to do is drive change. And actually, ideally, you will get those guys to be driving the smaller incremental changes, whilst you, as a leadership team, focus on the big picture strategy of how you can be better than the competition, where the gap is in the market, and how you can place it ahead of the market demand. So this is about training, and it's about making the team aware that it is their responsibility to drive the small changes. I'm very passionate about business plans. I think too many people have fallen to, oh, well, the market's too rapid, it's too volatile, we won't have a plan, we'll just be agile. And that, to me, feels too much like making it up on the hoof. I think it's about having a clear vision and plan. Agile is relevant for the small initiatives, but not the big picture vision and strategy. And then it's about working more closely with the second tier, both from a training perspective in terms of their skills, but also making sure they really get it so that they know what changes they are going to drive, so that it's not all on your shoulders in terms of creating the change and the change ethos. Listen, I've talked a lot. I could talk all day on this subject. As I say, I've written a couple of books on it. Please look them up. They're on Amazon. But I'd like to bring my colleagues Tim and Peter in. We're going to kind of do a bit of a Waldorf and Statler. Do you remember the guys in the Muppets? You know, they used to moan and mutter a lot about everybody else. So we're kind of going to do that style here today on some of the stuff I've talked about. So scale up to create shareholder value. We've got some questions here on the screen. But Tim, I'd like to bring you in first on the big one for me. We do a lot of fundraising. We're doing a lot of private equity investment. Money makes money, right? And these days, to get an emerging mid-market business from 300-400K to 8 million profit, you need to go and raise that money. You need to go and get those funds. Is that right?
Well, I think yes, it is right in certain circumstances. So if you're looking at your first question on the screen, biggest barrier to growth, is it capital or mindset? I think both are relevant, but the primary one for me is mindset. And I think what's interesting about it is mindset is within yourself, and in theory is the easier thing to control, whereas capital is external and you are having to convince somebody else to go along with a plan in some way, shape or form. But actually, as people, the most difficult thing we find to change is ourselves. So for me, mindset is the primary driver. I think the other thing is the number of times I have had conversations with people looking to exit, and when asked why, well, if I had more money, I could grow the business better. To which the response is, okay, fantastic. What's the plan for the implementation of that money? There isn't one. So again, I think it's mindset that's the primary driver.
Peter, you've been a serial entrepreneur, and I know this sort of hands-off stuff is quite important in growth. And I'm a grafter. I find it uncomfortable. I find the blue sky thinking difficult. I like to do. What's your experience around that and the mindset of people that I suppose they undermine themselves because they like to be busy? What's your view of that statement?
Yeah, I think as an entrepreneur in the IT field, you touched on the point earlier that the people who start businesses feel that they know everything about their market. They feel they understand how they can approach their customers. They feel that they can integrate and articulate back-end systems. But in reality, you have to take people with you. You have to have a team, whether it's internal and or external, to be able to grow a business, from 2 to 3 people up to 100 people. And on that journey may require acquisitions, may require external investment, but it is a mindset change between the true 3-4 person entrepreneurial situation to you get to that starting mid-market proposition you talked about, Kevin, the 20 to 300 people, and some entrepreneurs make that jump and they're the successful people. And some don't, okay? And they're the ones that stay at lower valuation points.
Do you think, we talked about, the specialities. Peter, you do a lot of work in IT productivity, for example, and
yes.
when looking at strategy. So I tend to be more what's the business model and the business plan. You tend to be, well, how do we implement that really well? But and that's different strengths, isn't it? It's very difficult to be as an advisor, good at it all. But why do people not go and get advice on this? This is about business design. It's about scale up. Either of you, what's your view on that? Why do people stay? They don't do that collaborative working. If you remember that slide.
Could I answer that?
You go, Peter.
I think there are 2 factors there, okay? Two macro factors, okay? I think that business owners see technology as an expense line. They don't see it as an enabler. Business owners, and I'm talking about small businesses, the ones that want to accelerate for growth. They see technology as an expense line. They don't see it as an enabler for their business. They see and consume technology as an end user product. So they're happy that their IT works, but they don't go looking and investigating for how they can connect together what I term, and it's so broadly used term, of these islands of information. And if you need to do, as a business owner now, more with potentially less, depending on the shape of your business, and you've invested in line of business applications that deliver your core services, islands of information will exist that you probably recognize, but you have done little with. And a lot of smaller businesses for growth need to invest in breaking down those islands of information. Let me give you just 3 quick examples. So at the front end of your business, you may well have invested in sales and marketing and a CRM system to go and find and trawl the market for new potential prospects. Well, that may be delivered as a software as a service application, and it has probably the capability to talk to your line of business applications. But what I find through the work that I do is that many companies have bought in to a CRM system, but when that CRM system spits out as a result, the result that the business wants, a new client, there's little connectivity between the CRM as a sales and marketing function, right, and the line of business. So there's a loss of information and a repetitiveness of process within organizations.
I mean, that's really important, because obviously I'm saying, look at the micro, macro trends for your sector. If you're a hotel business macro, you need to be looking at what Airbnb are doing. Every business is a digital business. And so what you're talking about there is, once you've got clear what the vision is, you need to make sure that you're going to do it in as high a margin as possible. That's all about productivity, and every business is a technology business. And Tim, your view on this, why do people not get, again, shareholder value as a key point. People design businesses around profit, but not shareholder value. Why do people not get advice on this stuff? Broadly, some do, but
Yeah, some of course do. We wouldn't exist if they didn't. But I think probably we come back to the nature of the entrepreneur, and the not knowing, not being able, is perceived as a weakness far too often. And the reality is, you cannot know everything. You have to bear in mind, most entrepreneurs started life as a plumber or an electrician or an IT specialist or whatever it is that their trade or skill is. How can they be expected to know everything? But all of a sudden they find themselves in this leadership role, which comes on to another interesting point, which I'll come back to. And they feel it is their role to know everything, to have every answer, to have the direction of travel mapped out. And asking for help or getting advice is perceived by them as a weakness or a failing.
It's Shakespeare's, isn't it? A fool thinks he's wise, a wise man thinks he's a fool, as you like it. And I think, actually for me, I'm going to try and have a go. I've mentioned EME, and guys, please start a wave on this, emerging mid-market. And I think it's because the definition of SME, small to mid-market, includes those micro businesses, which are the 5 to 20. And the skill set there is more hands-on. And actually, the skill set between the 20 and the 200 or the 1,000 is more leadership. And the advice is not well qualified, the difference between the two. And therefore, there aren't enough specialists within the emerging mid-market, if that makes sense, because the skill set is very different to dealing with the micro business, but it's also different to dealing with the corporate. Corporates aren't interested with your strategy; they want their IT, implemented. So that whole advisory piece within the emerging mid-market is sort of up for grabs. So I say, start the wave. Please use that phrase, because I think it's really important. And then understanding that you do promote yourself to so Peter's principle, you promote yourself to the highest level of incompetence. So basically you start to plateau when you move into that space where you've not been there before. Many entrepreneurs, for example, they haven't had really good corporate jobs. They don't know what a well-run corporate looks like. They jumped out too soon or what have you. So how can you replicate that? Difficult, because you don't know what it looks like. Bring in help. Guys, I mentioned I don't think people do business plans these days. Is that your experience? Am I being harsh and judgmental?
No, I agree. I think it is fairly rare in an early conversation with a new client that there is any form of written business plan in place.
Exactly the same, Kevin. As you know, we talk to so many customers that actually get us to write the business plans for them in the third party, because they don't understand where their strategy plan is defined.
But I also mentioned, I think there's two reasons. So again, shoot me down, disagree with me, by the way, or maybe put some other points forward. I said it's because I think people have fallen to this misuse of the word agility. And that for me is the heart of it. But they've done that because change is too quick. There's too much volatility, there's too much compliance change, or COVID's another example of significant risk that's hitting our business. There's too much headwind, which saying not only do we not understand the word agile, but we're kind of embracing it too much, and it's forcing us to look down. What's your view on that?
I think you're being too kind to us all as entrepreneurs. And I think that giving the sort of excuse of pace of change and this falling back on agility is an excuse. And I think it comes back to something far simpler. And you alluded to it earlier in the conversation, Kevin. It's the difference between director and manager. And if you simply look at the wording, a director's role should be to lead the direction of travel. And a manager's role is to manage the status quo. So one is about change and one is actually in place to prevent change. So, for those two roles, I think there's two issues here. Most directors in both SME, but SME probably necessarily so, but the emerging mid-market are spending far, far too much time in management and not directorship. And I think we just see that over and over again. It's 90% plus of the time that's what we come across. So I think there is that side of it. But when you then look at the difference between directorship and management, to lead management in a direction, you have to have something tangible and written that gives that direction, gives some people something to work to, creates that direction as travel. But I think more importantly, it's that creates the KPIs where you can actually make a judgment call as to whether you are succeeding on the right path or not. And of course, there's going to be forks in the road. There's going to be changes in plan as you go forward because there are unknowns going forward. But having that plan there is critical, in my view.
It's quite interesting you identify that, Tim, because I think we're very good friends with the Institute of Directors, where lead provider for their corporate financial strategy. We're forever having a conversation with them that they're quite governance focused, and we'd like them to be more leadership focused, if that makes sense.
Yeah, totally agree.
Within the job title directorship, so it's quite an interesting point with that. Peter, what's your view on this whole agility versus planning?
Right. So having started and successfully sold, a number of businesses, I never started with a business plan. The business plan for the entrepreneur, is in the mind. Okay. But okay, the bit that's important is selling the business. And when you come to sell the business, whether it be to an external investor or the whole platform to another part of the market, one of the first things they ask you for is where's your business plan, okay? And you retrospectively, writing the business plan down to fit around what you've created. Having also had the experience of taking a small company through to what you're terming EME, okay, up to 100 employees, it is core at that stage to have a plan written, because you have a management team underneath you that is supposed to deliver something, right? And delivering something which is only in your brain, right, is not a tangible and efficient use, okay, of their ability to be able to deliver against the plan.
Yeah, that's valid. I mean, actually, I'm minded of that, Peter. You're working on a project at the moment where, do you remember I said, guys, leadership, new products, strategic alliances, acquisitions, territories, they've got a great new product, but they've recognised that, the core business needs them. So they've got you involved to help drive the growth on that core product and define it better and understand it better. So the other thing is, from a time point of view, you don't have to do this all internally. You can get help externally. I think that's quite an important, it's certainly their conclusion. So I think it's quite an important bit. I mentioned earlier also about clarity, and I've really majored today on just saying no a bit more. And I'll just share with you an analogy. I like my history. So if you remember the D-Day landings, we broke through in one place in Normandy, and they took 2.5 years to plan what that place was. And it wasn't necessarily the weakest point. There was a bit of distraction involved, but they focused on that one point and chucked everything at it after 2.5 years planning. If you fight across the whole front, you will never break through the glass ceiling because there's too much going on. So my point here is one of focus, which is, where can you be better? How can you be ahead of the competition with that market demand and focus? People, I think, do grasp that, but then they forget to just say no bit. What's your view on that? In other words, they're off flying kites again. They go, oh, well, that's a great idea, and then they dive into that. What's going on there? Why do we get distracted?
I think it comes back to this sort of lack of, well, I think there's a number of points. I think generally we're all fairly nice people. So I mean, not us as the three of us, or necessarily those who are here today listening in, but as a species, we are generally all relatively nice people. And it's very comfortable having nice conversations with nice people in all sorts of settings and circumstances, and wanting to help. Whilst I don't think that is flawed, and I'm a great believer in, if you do have a prospect contacts you, but it isn't a project for you, and that's in our world a project, but a client for you, a what have you, depending on what your business is, I still believe it is good for that individual to go away feeling something positive for the conversation you've had with them. But hopefully you'll have that conversation in 5 or 10 minutes, not an hour, once you recognize it's not the project for you. I think the other thing is, it come back to this, in writing. So, yes, if you're drawing up a 4, 5, 6-page business plan, your people are not referring into it on a daily basis when they're making active decisions. But one of the things we had in our office is we had our process written in very, very large letters across the wall. And it just stated marketing, prospect, client, and I won't bore you with the whole detail. And it enables you to say to your team, or people within the team, in overhearing conversations and activities going on elsewhere, is, does what you're doing fit with that agenda? Because if it doesn't, you should be saying no. And interestingly, as often as not, that can be internal distraction as well as external.
Yeah. I mean, actually, this is really important with acquisitions, because when we do our acquisition talks, and we can't talk about scale up to shareholder value without bringing a bit of acquisition in it, because that may be the icing on the cake for a business. Is, you get to a certain point as an EME, and then you need to do that 1 or maybe 2 acquisitions to take it to next level before you exit out. And that is a really successful strategy employed by a lot of people. But again, saying no so that you're really clear on what you should be buying and why you should be buying it. We discuss it. Know yourself before you presume to manage others, but also before you presume to buy others. So with acquisitions, why are people, they're a bit unfocused. Again, they don't go and do the direct door knocking on the really key people they should do. Why are people hesitant?
Are they hesitant? I'll be honest with you, Kevin. I thought you were going to go in a different direction on that one. I think that for some, it's just almost an otherworldly thing that other people do and is beyond their scope. I think for me, one of the key things to talk about with acquisition is that they are too price driven too often. And the wrong acquisition that doesn't fit isn't going to help in the direction you are going on, isn't going to meet those 4 corners of M&A, or at least 2 or 3 of them. Let's be honest, nothing is perfect. It doesn't matter whether you bought at a discount. If it isn't going to achieve the goal, well, it's bought at a discount. We call it a discount to disaster. The wrong acquisition can have exactly the opposite effect than you're looking for. So the cultural fit, direction of travel, all these things are far, far more important than price.
I remember a deal we did, Pentagon IT, they did Prince 2 training, and they had a landing platform that was basically virtually Prince 2 training or something. I can't remember the name of it, but the multiple was off the scale because they just wanted the landing platform, because it was all about traffic for that training keyword. I mean, it was a profitable business and it made good money anyway, but the buyers were really clear their strategy, and it was a great deal for them. Their strategy was all about bolting the business on and using that domain name as a means of bolstering their main IT training business. So I think it's also understanding, again, come back to your strategy, it's understanding how the acquisition best fits it. But I don't know whether people. So one of the things that we suggest is that people look too generically. They don't do enough work on who they really should be buying. Looking at that sort of, not trying to approach 100 people, but if you were really looking within your niche against that market demand that you're forecasting, who are the 10 people and only the 10 people you should really buy, and then sweetheart them. What's the view on that?
I think that's quite a difficult one, and I think that depends a little bit on scale. If you are already in the several tens of millions of revenue and multiple millions of profit, then there's probably fewer targets to be going after. I think if you just simply look at the smaller end of the market, so I don't know, pick an industry, any industry. Peter, there you go. You're a small IT business, managed service provider with 2 million revenue, and you're making a nice couple of 100-300 grand profit, something like that. You want to bolt on another £1 million worth of revenue. I mean, I don't know the answer, but I'm relatively sure if I went and looked at the number of companies in the UK that fit that profile, it'll be coming up into several hundreds, if not thousands, not tens or 20s. So I do think there's an element of scale there. At the smaller end, unfortunately, I don't think there's much choice but to be a little bit more generalist. Although, having said that, geography factors and things like that might kick in, which might narrow your target audience. Okay,
it's useful, Tim. And it's good. And I think so, acquisitions are an important part of a scale-up strategy, an important part of shareholder value. We talked earlier, Peter, about time, and I've talked about leadership, but actually IT productivity is all about freeing time up, isn't it? Now, most EMEs do not have a chief technical officer, do they? So that's one of their challenges. So you tend to find.
Could I heckle Kevin as
go on? You disagree with me on
that? I'm sorry, not heckle. Add to. I think yes, the time side of it is critical because time frees up resource to do other stuff, whatever that other stuff may be. Hopefully, positive stuff. But I think also a joined up IT creates data. Data enables decisions to be made. Data enables you to monitor the success of initiatives. So I think there's a real double whammy to it.
Closed loop on that. Yeah. Peter, I was about to say with it that people don't have CTOs, which big companies do, and for me that's a gap in a scale-up strategy.
Yeah, I mean, in the EME, in the smaller market, affording a quality CTO, is probably too much to bear. Okay, so the role is split across the board, and the finance manager, finance director, between them having a rudimentary understanding of how to put together technologies that appear to be out of the box, as I say. They probably also have some kind of management break-fix IT company that comes in and mends their stuff. Okay, but mending stuff, making sure it works. Okay, that's just the baseline. Okay, if you want to increase your productivity, take your line of business and make the process more efficient time-wise and cost-wise, and have a strategy. You need somebody, right, that understands how to put it all together, okay, and make the whole lot sing. And many companies don't have that, but they feel that they need it. And
that's useful, Peter. We're now running out of time, but I'm just going to do a little plug, because we don't do these webinars for nothing. We want your business, guys. So yeah, at the end of the day, scale up for strategy. This is a slide saying, look, guys, one of the things that we are offering as a service is we are happy to come into companies on a day rate basis, typically between 7 and 15 days. We will do that whole strategic IT and business planning review and tell you what you've got objectively. So if we've struck a chord anywhere, do give us a call. We're very happy to sort of talk through some of the stuff we've got here. We guarantee you'll get some ideas and hopefully some shifts in both the scale up vision and also shareholder value, but also very specifically also IT and process reviews. So if you're looking for a more immediate post-COVID gain, that's a good one. Let's make the organisation more productive so that we then free out more time. Then we've got more time to look into the strategic energy and growth of the business, rather than completely disrupting the business model from the start. So I think that's us out, guys. Tim, Peter, anything you want to say, or Joel, are we happy we've covered most of the ground?
No, sounds good to me, Kevin.
Yes, I think so. I think I would finish off by just saying we obviously don't know what we're going to be talking about on the 12th of November yet, because we don't know what the tax regime is going to be at that stage. But well, that should be interesting.
Yeah, good. Okay. Well, I think that's right. And we're kind of taking a punt, but obviously if they knock capital gains tax up, we're going to be talking about Portugal a lot. But it does look like they're going to delay the autumn. So I think it's going to be more like April 2020. And the big one for M&A is going to be on capital gains tax. Are they going to knock it beyond the 20% to 40%? And what's the impact? But look, guys, really helpful. This recording is going to be available. It'll be going up on our website and possibly some of our partners' websites. So if you want to share it, please do. Also, we're very happy to talk about any of the concepts. We've got various guides, books and materials, so do pick the phone up. You'll see our emails on our website and contact details. So please contact and follow up. Thank you all for listening. Really appreciate it. Thank you, and stay well.